We have just entered June. The sun is finally out here in the UK, and today we're back with another Vanguard portfolio update. For those of you who may be new around here, my Vanguard account is not my active account, so I'm not actively putting money or withdrawing money from this account at all. This is my stocks and shares ISA from a couple of years ago. So I just tend to leave it alone, reinvest the dividends, and hopefully over many decades it grows and I'm left with quite a nice little pot of money. At some point down the line, I may decide to transfer this to have my whole investment portfolio in one place. But right now I'm pretty happy to leave it as it is. Vanguard is really cheap and I kind of just like having it as my ETF portfolio that I've just set and forget and I leave it alone. I currently invest on Trading 212 and that's because I like to invest into individual stocks as well, and Vanguard don't offer that. You may have already seen my Trading 212 portfolio update videos where I go through that portfolio in more detail, but if you want to open an account with Trading 212, a stocks and shares ISA, or even a normal general investment account, use the link in the description. You will get a free share worth up to £100 and you only have to deposit £1. So since my last update, not a lot has really been happening in terms of the UK market. If we look at the last 1 month in the FTSE 100, we can see that it's gone down by 3.79%, but it's not really done an awful lot of good. It's not really moved that much. And I think that's because in the UK, we don't really have any of those big tech companies. We don't really have those companies that are currently chasing this AI revolution that we're seeing at the moment. Typically, in the FTSE 100 and in the FTSE 250 even, we tend to have more of those boring, stable companies. Now, there's nothing wrong with those. I use the word boring very lightly here because some of them are fantastic companies in my opinion, and I have some on my own portfolio currently. But we're not really seeing the moves that we may be seeing over in the US at the moment, and I think one reason for that is because of our lack of exposure to the big tech companies. It seems like at the moment, all of the companies that can are trying to pile their efforts into AI. They want to move their companies as fast as possible to keep up. And this is, of course, creating quite a lot of movement in the stock prices. If we jump over to the S&P 500 and we look at that over the last 1 month, we can see that there's been some real volatility, some real peaks and troughs, ups and downs, but overall it's up by 0.35% over the last 1 month period. As I mentioned in my last update video, inflation is still a pretty big deal here in the UK and it hasn't really settled yet. And it's definitely not yet at that 2% level that the Bank of England are aiming for. If we look at this website here, Trueflation, I love this website, definitely check it out. It basically shows you a more realistic level of inflation in the UK, or you can switch it over to the US. So you can see that right now the inflation rate is definitely not sitting anywhere near 2%. The UK government is reporting 8.7 right now. True Inflation uses their own data and they are reporting more like 13.26%. So you can see here on the chart, we've been going down, but now we're sort of going back up again. It doesn't really matter on the exact number here. The point is we're still at high levels of inflation. To deal with inflation, one tool that is typically used time and time again is to raise interest rates. These two things, inflation and interest rates, are kind of like a seesaw. When one rises, the other goes down and vice versa. When they go up, this tends to have a knock-on effect on many different things. One of the big things that happen is that people get better rates in their saving accounts. And when you're being offered better interest rates on your saving accounts, some people tend to then shy away from spending their money or investing their money, and instead they look to hold it and save it within a bank account. And although I do believe that everyone should have an easily accessible pot of money, an emergency fund sitting in a bank account that they can get to very quickly should they need it. And if there's interest rate there, then, if they're getting paid interest, then even better. But I do question whether the saving accounts interest rates are even close to matching the inflation rates. Because if your interest rate is not matching or beating inflation, then you are losing money. Your purchasing power is going down over time. Because of this, I do believe that a lot of people should educate and learn about investing, at least with some of their money. And just another quick thing, I've just said that interest rates are rising on saving accounts. So I urge you to have a look around. Go and try and find the best interest rate account that you can get your hands on, because Although you might still not be beating inflation, you'll be better off having 4% over 2%, for example. So just go and shop around whilst the companies are feeling the pressure to increase the interest rates. Also, mortgages. So I'm talking about a new mortgage or a remortgage, not fixed term deals that are already in place, are in a bit of bother as well, because of course the interest rates on those are going up, and that means that the repayments are higher. I actually saw this article this morning published by BBC, and it's saying that nearly 800 mortgage deals have been pulled over the uncertainty rates. Nearly 10% of all UK mortgage deals have been taken off the market since last week due to the high interest rates. So that's just going to show you what effect this is having on the housing market too. So moving over to the US now, the biggest economy in the world, and they are having issues too. The debt ceiling ordeal. For those of you who have been hearing this debt ceiling phrase thrown around but aren't really sure what it is, it's basically the legal limit on the amount of money that the US government can borrow. This debt ceiling was created back in 1917, and it's been raised 108 times since then. So the US government has been basically running into a deficit for many years now. This means that they are spending more than they are taking in, put simply. And to make up that difference between what they're spending and what they're taking in, they have to borrow money. So the debt ceiling has been set at $31.4 trillion. And the government is expected to reach this debt ceiling come June 2023. Today is the 1st of June 2023. And if that debt ceiling is not actually raised, so raised for the 109th time, then they will basically not be able to borrow any more money. And this would lead to a default on the national debt, and quite honestly, all economies around the world would be very affected. And it's really difficult because the debt ceiling is a bit of a political issue. The Republicans and the Democrats have different views on how to deal with the debt ceiling. So reaching a decision is pretty tough, and it tends to draw out for quite a while, and it really does always approach that deadline. As I was literally making notes for what I wanted to speak about in this video, they actually passed the bill. So they reached the decision to raise the debt ceiling for the 109th time. So like I was saying, in the US right now, we have many of those big tech companies that are following this urge to move forward with the AI movement. You can see here the components of the S&P 500 ordered by weight, and you can see that Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, Tesla, like you can see that a lot of these companies that feature quite highly in the S&P 500 are those companies that are real players in this AI space. So it's not really surprising to me that the S&P 500 and the US economy in general has been quite volatile over the last 1 month. I know in my own portfolio that I have on Trading 212, I hold Tesla and I hold Palantir, I hold Amazon and I hold Alphabet. And just those four alone have been crazy good, don't get me wrong, they've all been going up and it's been amazing, but nevertheless I always feel like the plunge is about to come, so it's been quite volatile over there. Palantir and Nvidia have been crazy right now. They've been particularly insane. Look at this, 1 month, over just 1 month, Palantir has been up by 90.55%. Like that is insane, nearly 100% over just 1 month. And then if we look over 6 months, 88 points changing because the markets are currently open, percent. Year to date, 132. That's crazy. It's absolutely mad. Now, I will say that Palantir aren't currently part of the S&P 500 index. They need 2 more quarters of GAAP profitability to be included. So watch this space. I believe that is going to come. And then if we look at Nvidia, 1 month, 35%, 6 months, we're seeing crazy things here. Year to date, 172, 1 year, it's madness. It's madness. If you got in at the right time, in Nvidia particularly, you'll be seeing some absolutely incredible results in your portfolio right now. I am a holder of Palantir, but personally, I'm not about to take profits or sell or anything like that. That's a very long-term investment strategy that I have with that one. So now we jump over to my Vanguard portfolio. First thing that you can see, my ISA value, £6,299.21. Last month, this figure sat at £6,150.96. So you're probably wondering why such the difference when you're not actively investing into this account. I'll get onto that in just a minute. Another thing that you can see is my biggest holding, S&P 500 VUSA, one of my favorite ETFs. I think it will always be one of my favorite ETFs. I have the most in this, nearly 69% of my entire ISA on Vanguard is the S&P 500 tracker VUSA. So you can see that that's the amount that I have in there right now. Available cash, you might notice that this has gone down since last time. We'll get to that as well in a minute. And my personal rate of return since the account opened is sitting at 6.53%. Personal rate of return is a funny one. It also takes into account any money that I add into the portfolio or withdraw from the portfolio. So just bear that in mind if you're seeing crazy high rate of returns in people's accounts. It could just be that they're putting money in. It might not necessarily mean that they're picking the best stocks in the world or seeing great performance. It could literally just be that they're putting a lot of money in. Bear that in mind. But anyway, I have not been putting money into this account for quite a while now. So my personal rate of return is a little bit more accurate perhaps than it has been in the past. Let's go over to this investment tab and we'll go to full details so we can see everything here. So I only have 2 positions in this account. I have my VUSA ETF, which tracks the S&P 500, the largest American companies. And then I also have an index fund, the FTSE Global All Cap. If you're wondering about the differences between different Vanguard index funds and ETFs, I've got many videos on my channel about that. So like comparison videos, so check them out if you're interested. Let's just have a look what's been going on here. So FTSE Global All Cap. Last month, I was down by £44.53. This month, I'm still down, but I'm down by £20.16. So over the last month, since I filmed the last update video to now, this position has been doing a little bit better for me. To be honest with you, I don't check this account unless I'm filming a video. So this always kind of comes at a little bit of a surprise for me too. But at the moment, the value of this position for me, if I were to sell it all right now and walk away, which I am not going to do, is £1,870.82. VUSA last month was actually down by £43.96. You can see that this time round, we're actually up by £80, pretty much £80. So whatever's happened to those big companies that make up the S&P 500 in the last 1 month has very much helped my portfolio. And I have a sneaky suspicion, given what we've spoken about, that a lot of this may be down to those tech companies having a really good performance. And some other companies that have been doing really well since their earnings have come out and all things like that. But I'm happy to see this. I don't really care, to be honest, I've said this time and time again, what these do on a month-to-month basis. I only care that these go up gradually over time and one day I'll have a nicer amount than I have currently. So now looking at my cash statement, so any money that has gone in or out of the account since I began this portfolio. Last time I told you that I was paid a dividend from VUSA, £15.75, so that was in last month's update. Since then, I've not received any more dividends. The only one that pays me dividends in this portfolio is VUSA, and it pays 4 times a year. So every 3 months I get a payment from them, and it typically is a bit late on Vanguard, I will say that. You can see that I've got some interest that's come into the account, very, very small really, nothing really to speak about. I have had an account fee come out, again, very small. Vanguard is very cheap, but you'll also notice here, I seem to have purchased some VUSA, and that is because I've reinvested my dividends basically. So I let my dividends accumulate on my account over time. And then when I had enough to cover 1 share of VUSA plus leave some over for the account fees or anything like that, I decided that I would purchase 1 share of VUSA basically. And you can do that. If you've got an active stocks and shares ISA elsewhere, then you can't actively put money into an old ISA. But what you can do is you can use any cash that is on that account already. So this money wasn't me depositing onto this account to then use. This money was simply already there from getting paid dividends and cash left over from when I was active on this account essentially. So I basically put that money back to work. And it's really important to reinvest dividends. Like it's super, super important. It basically helps accelerate the growth of your portfolio. It makes the investments grow faster than if you were to just take out those dividends in cash and spend them on whatever. It basically comes down to reinvesting the dividends, buying more shares, accumulating more shares, and then the next dividend payment gets better and the compounding effect just keeps happening time and time again. I just want to say a quick thank you to everyone that watches these videos and subscribes to this channel. Honestly, it means a hell of a lot to me that you even turn up and watch these videos, and even more that you would subscribe or comment or join the Patreon or anything like that. Honestly, blows my mind, and I'm very, very grateful. Let me know how your portfolios are doing, and thank you so much for watching. I'll see you in another video very shortly.